What's going on, legends? Welcome back to the Chase Immortal Podcast. Now, this will probably be episode 10 or 11 once this airs. So we're well and truly away here. We're flying, and this segment with Daz is really kicking off. It's getting some really good feedback. I've had a lot of people sending me through messages and talking about this episode with Daz. So we've just finished recording another one. Runs for about an hour and 30 minutes. So we're getting a little bit longer now. We're getting into the meat of it. We're going into digging deeper into stuff, digging deeper into investing, all that sort of stuff now. So any questions you got, Daz touches on it in the episode coming up. If you've got any questions, anything you want answered, any stuff that's not making sense, like anything that we're talking about that you want explained further, just reach out, send a message, leave a comment on YouTube, on Instagram, send through a DM, whatever. Any way you want to get in touch, and we will bring it up in the future episodes. But it is getting into the meat of it now, so yeah, very interesting stuff for anyone who's playing along. Go back. I urge you to listen to it from the start because it is very interesting and very informative. Once again, we're not financial advisors, so just a quick disclaimer, any of the information in these episodes is not financial advice. Please seek financial advice from an accredited, licensed financial advisor before investing any money into anything. We're just here to spread Daz's good information that he's gathered over his years of research. But yeah, definitely not accredited financial advisors. Thanks to our sponsors, BHM Resources, Coastline Mechanical, BH Engineering, Manic, Mafia. There's so many good people getting on board this now. We've got so much going on. WA Women in the Spotlight. That's going through gangbusters through the roof, so please get on board that. And Chase Summit tickets, get on there now. There's plenty of codes. You'll see them online. Jump on chasesummit.com.au to get your tickets to the summit. That thing's going through the roof as well in November. But yeah, plenty going on. Go over and enjoy this episode. It's another cracker. So thanks for everyone. Like, share, subscribe. You know what to do. Cheers. See ya.
3, 2, 1, 0, and liftoff.
Righto, what's going on, legends? We are back. Check out this apartment studio. We've got plant and everything going on.
Looking good.
It's looking good. How you going, Daz?
Good, man. And my space is still looking pale. I must
right.
uplift. You know.
You're a busy man. It's all good. So there has been a massive, like this episode, all the other stuff we're doing is sensational, right? We're doing a lot of stuff for mental health, a lot of stuff for like men's, women's health now as well. We're pumping up the summit. We're doing all this cool stuff. But this episode gets the most feedback. I get messages from people every day about this episode. Like I got one the other day. Actually today I was in the gym. One of my mates rang me. He's like, "What's going on? What are you up to?" Right, so I'm going back to work tomorrow. Just gonna get a train in. Catching up with Daz again this afternoon to record another episode. He goes, "Man, all the boys at work." One of the boys at work just rang me and said he just rang his missus. Finished the last. It must have been the first episode, the one where you tell them about the subscriptions, Netflix, and he's like, he just rang his missus, said, "Cancel all of them except KO Sports. We don't need them. We don't need Netflix. We don't need Disney. We don't need all that. Get rid of them. Just keep KO Sports so we can watch sports." So it is so good. The feedback we're getting from this, and we do have a question from a viewer. I'll get to that a bit later on. I think I sent it to you earlier. I'll have to find my phone and have a look at that name that I was talking about earlier.
Yep.
But yeah. So he is the bloke who actually sent that through is the bloke who gave me the advice about your credit card use your credit card and pay it off once a month. And he goes, "Man, it was good to listen to Daz's feedback about that." And like, da-da-da-da. And I'm like, yeah, it's spot on, man. Like, killer. So yeah.
So that's so good, man. Oh, look, just firstly, it's really, really like pleasing to hear all this great feedback, questions as well. I did speak to you offline a little bit. We'll plan on opening up a mailbag segment because you know there's a lot of questions and a lot of elaboration that can be done in between, right? So absolutely happy to open up a mailbag segment and start answering people's questions direct as they pop up. But yeah, look, super pumped to get all that feedback, mate. And like I've said to you right at the start of all this, if we reach a handful of people, we've done our job. And sounds like it's already starting to help more outside the sphere. So
Like
Yeah, it's
by
been
the time this airs, there'll be 10 episodes of the Chase Immortal podcast out. We've only been going for like 3 months, like 4 months max. Like, and that's
So
just
good.
drip feeding it in. And like, man, this thing is going good, like real good. Like people are loving it. And I don't look at all the like YouTube views. That shit doesn't bother me. We're doing good shit. We're putting it out and we're getting feedback from people. That's all that matters. Like I said, if we're reaching one person or 10 people or 20 people and we're helping them out, cool. Because I love this shit. Like this is my favorite pastime now. I love talking to people. Like I've talked to 3 different legends this week, like real good people about real cool shit. And I really enjoy spending my time doing this shit. So it's good to get this shit out.
Man, it's awesome. I've been loving. I'm a few episodes behind, but I've been loving all the convos that you've been having. Everyone's just got. It's so inspiring to listen to be honest. Like I'm sitting there nodding along. We've said all along, like none of us are experts at this stuff, right? We're just having conversations, but we're
100%.
probably just curious enough to start asking the questions and then starting to piece together some solutions. So anything we can do to share that shit, man, let's bring it on. Like I've said to you in the past, like no one's autistic enough to read 69 books on finance. So I want to skip that effort for you, right?
Yeah.
So I don't want you to have to go and read 69 books. So if I can distill down some of the bullshit that's contained in those 69 books and outline some things that you can think about, then that's great. Like, well, effort well done, like on my behalf in terms of like, just got to share it, man, because people don't have time, capacity to understand the world that we're walking through. We've spoken at length about the downstream effects of, how we show up. You're doing phenomenal work with getting some of these conversations out in and around mental health and just those avenues that are available to men to seek help to go and offload some of the trauma that you carry around. Just basically as a result of trying to navigate life, mate,
And the knock-on effect from that, right? When we started, the amount of women that messaged me and said, oh, you're just a big testosterone chest-beating group of boys just talking about, And I went, no, like, right, I'll show you, right? So I went and sort of speared it in another direction. So now I've started doing some work with some of the women around Perth. Some of this stuff, like a lot of women I've spoken to say you can't find these communities to do this stuff. In the last month, I've found 3 massive communities that's all they do is like pump up events for women wanting to meet other women to go and meet up and do stuff. And I had a good chat with Liv that runs WAGS, which is, I'll probably get this wrong, but it's WA Girls Social Society. So she started that. And it's literally just girls that get together and meet up and go out, and girls that don't have confidence to go out and to a bar or meet people or go out on their own to a gym and talk to people. She puts all this stuff online and they go, oh, yeah, it's cool. They're going down the beachfront to meet up and go for a walk or whatever. And they just all meet up and then they all become this big. Now she's massive, like huge. And that's the sort of shit, you know what I mean? Like you can't, unless you're out actually looking for this stuff, you're not going to see it. But since I've started talking to these girls, these communities are out there. They're huge.
There's a lot of crossover too, right? Like a lot of what we speak about specifically to the boys, it equally applies to women.
100%.
And likewise, I think women are starting to appreciate too that there are avenues for men, because men typically do cause a lot of friction in relationships, right? They're the catalyst for it because we got full of testosterone and masculinity and anger to a certain degree, and we're a few really great books to read. If you ever want to explore that further, and one's like it's a bit of a cliche, but there's a book, Men Are From Mars, Women Are From Venus, I think it was called. It's a great book, just explaining we're just wired differently. We just show up differently. We navigate 100%. The world differently, and we have different values, and it's important 100%. To just call that out. But I guess to tie all this back to our episode, right, is again and again and again, money keeps showing up as one of the major catalysts for the breakdown in these relationships, for where we start to get really dark in and around ourselves. Is normally money's a massive catalyst for that. And I've spoken about in the past, in the last couple of episodes, about how it starts to distort how we show up and how we communicate value to each other. And that's all tied into mental health, depression, relationships, everything. It was one of the major catalysts of fights in relationships.
A big thing with relationships, if you've got, and this is that word again that we've used every episode, optionality, right? If you've got the optionality for the man to go and work, leave your wife at home to raise the kids, look after the kids, you're going to be a lot better off. Like if your wife can stay at home or your partner can stay at home, you're going to save on daycare fees. You're going to save on all this stuff, right? Paying for your kids to go to daycare, paying for all the extra curriculum stuff to look after them while the wife's at work as well. If you're just out there, the breadwinner, and like, I know it's not for everyone, like it's not going to happen in every situation, but if you've got that optionality where your wife can stay at home and if your wife can stay at home and raise the kids and you go to work, how much better off are you going to be financially? Your kids growing up with their mum there flat out, like instead of being in daycare, instead of being looked after in after school care and all this sort of stuff because both parents are working.
You hit it on the head, Benny. It's options, right? It's like, that's not for everyone. Some women love careers, and I'm happy for you, but other women just like being mums, and that's cool too. But this modern society of ours doesn't, unfortunately, let you exercise that or makes you feel guilty for even wanting just to be a stay-at-home mum, right? It's like, oh, no, what about your career that you spent 7 years fucking studying for and all this? You know, it's just options. So if you feather your bed, if you get the nest home, the nest feathered at home, then you can just exercise that option. And I know other couples who have done this and done that well, where the dads decided, hey, you want to be the career mum? I'll be the stay-at-home mum.
Off you go.
Not for me. I'm a shit mum. I know that. I've tried. I'm no good at it. Yeah. And this is where, you know, for us as a family, if I think back, my wife has worked a lot through that whole journey, but we've been able to put ourselves in a position that we have had those options, right? We have been able to exercise those options. And for me, realising early, I wasn't a great mum. She was the great mum, you know? Yeah. Now it's my turn. My boys are old. I'm every week, sport. That's what we do. That's what Dad does, takes them to sport. So it's my turn to stand up now and do all of that. And it's only because we've got the optionality to be able to do it, where I've been able to go, you know what? I missed all those years because I hustled, right? I missed all those formative baby years, but now I don't work away. I've made that choice. I've got that option not to do it so that I'm home every day. I can take the boys to school. Me and my boy, I take him to school every day. He's 12. He's gone through puberty and all these. We're having those man-to-man conversations, man, and we have bonded so much better.
All the cool shit,
man. Yeah. It's great. Like we're becoming best mates. It's unreal. You know?
Yeah, it's good. That's what you want.
It's only because I've had the option to be able to go, well, I'm not working away anymore. I don't need to earn that extra hustle. Now I can start to point that. Yeah, exactly, man. That's what it's all about.
That's what it's all about. Now, quick recap. So this will be episode 4 of the hustle, yeah?
It will.
So we've done episode 1 was a bit wishy-washy, was a bit of an introduction. Episode 2, we got started getting right into what we're going to do. But I reckon the last episode, man, like really started digging deep into where we're at, like globally, like where we're at in our own personal lives with money, where we're at in the global financial scheme of things and how we got there. And like you say, the meat and veggies. So where are we at today? What are we on today?
Well, I'm pleased to say we've been eating the veggies the last few weeks, and we're going to start chewing on the meat. So this is where it starts getting juicy. So the last couple of episodes, and if you haven't listened to them, strongly encourage go back, listen to 1, 2, 3 in order. So it will frame up a lot of the conversation. So we're going to assume that you've listened to a lot of that. We can recap on some of that absolutely, and tie back what we're going to discuss today. But ultimately, where we've led to is a really big discovery on what is money for a start, and then monetary history, how we got to where we are today. And I'll tell you a little, if you haven't listened to episode 3, money hasn't always worked the way that it works now. We call this money that we now operate in fiat currency. It is fiat currency, is backed by fiat means by decree. Governments make us use this money, and it's not a very good steward of our time and effort, right? So it loses purchasing power hand over fist. And the number one reason since 1971 we left the gold standard, where our money was actually backed by something, and now we're just on Fugazi. It's just nothingness, right? So, and they can print it out of thin air, and the only thing stopping it inflating away to hyperinflation is just a few different mechanisms, but it's basically just trust and faith in government, right? And I think if we are to critically go back through history, that trust is eroding, and it's probably starting to accelerate. And a lot of what we're starting to see geopolitically and globally is symptoms of fiat monetary collapse. Fiat money is not a new thing. They have tried it over the centuries. and every single one fails. We are arguably at the longest reign of fiat currencies in recorded history, but it will come to a head, right? And this is where it all boils down to. Now, how that affects you is you cannot save in money. This is the last 3 episodes have basically brought us to the fact that you cannot save in money that we understand it as today. You cannot save in dollars because of a number of things, but the number one really being inflation, right? The erosion of your purchasing power is far outstripping your ability to save, and that is the number one. So that brings us to the question, what the fuck do I do, Daz? If I know all of this, you've been banging on for 3 episodes about the fact that money is shit. That's great. Now what do I do about it? So unfortunately for you, it does mean from this point on, you have to invest. You have to. There is no other way of sugarcoating it. When money doesn't work, you have to invest. So today, what we're going to start doing is chewing down on the meat in terms of, well, what are your investable options? So we're going to go right through. I'm going to teach you guys about bonds. I'm going to teach you guys about equity. Obviously, real estate, everyone's got a generalist understanding of.
Well, I don't think people do have a general understanding of real estate, but they do not understand. I don't think people understand what they're actually investing in when they do buy real estate. Like, I know some people think that it's a long-term security thing and it's going to get you long-term benefits and all this sort of stuff, but there's a lot of other stuff in the background that, like, you don't think of. Like, telling you now, like, when I was invested in property, like, I'm not invested in it now. I've got the place I live in that I've bought and I've got a mortgage on. That's it. I don't have any other property that I own, but I don't think I would go to buy property. I don't think that's my next move. I don't think I'm going to do that with my excess money that I've got to play with. Like, I'm not going to go buy another house or another apartment and have it sitting there until I retire. I don't think that's the option.
I could not agree more. There's a number of risks and trade-offs, and there's a good thing. Sometimes we're guilty of dealing in absolutes, right? And there are absolutely fringe cases and fringe studies in and around some of the discussion points we're going to have today. And you will know, your cousin's sister's dog made billions in real estate. Yep, cool. I get it. That's great, and I'm happy for them. But what we're starting to see is those opportunities are becoming rarer and rarer, and we're beholden to government decisions on whether that thing continues to go or not. And to a certain degree, all investing is really, really beholden to a couple of things, like government decisions and central banks. And those 2 main decision points are really, will I control interest rates? Yes, they will continue to do so. Will I keep getting into debt? Yes, there's a debt spiral, and we can do a whole episode on why that's true. I won't get bogged down into it right now, but we are in a debt spiral. They literally cannot pay down the debt that they've accumulated. And I'm talking US, I'm talking Australia, I'm talking every major developed nation is just in a debt spiral. And the only way to service that debt is to print money and control interest rates. And they will continue to do so. So what is probably the biggest danger then for people as they try and navigate this is, to what degree do they do it? Because they'll do it into perpetuity, but how much do they throttle it? And really, real estate's probably the best one to express in terms of the risk to real estate, because it so greatly affects people's cash flow. And I'll get back to real estate. We'll park that for a conversation for a second, because I'll come back to real estate. I want to sort of take everyone on a bit more of a journey in and around some of the other options that we have. But
because this is where it gets scary for people, right? This is where the investment part gets scary for people. Like, that's your money, your hard-earned money sitting in your bank. When they're thinking about investing, it gets very scary if you transferring your money into something that you're trying to make grow long term, right? Yep. But everyone trusts superannuation, right? Mm-hmm. Like, it's just a given. Like, you trust your superannuation. Like, people salary sacrifice into your super. Why do you trust your super? Why are you trusting these companies with your money? Like, that run your super? Like, I'm starting to open up. I'm starting to come through the matrix. I'm telling you. Like, I'm like red pill, blue pill. I'm in this. I'm in here. I'm telling you.
And look, the whole point is not to scare people into inaction, but
it's scary. It's scary. Investing is scary. Like, it is your money. It's just scary. So this is the part where we need to navigate our way through. What are your best options?
Yeah, and there's a really good saying. You will get sick of me saying it, right? But it applies to just about everything in life. There are no solutions, only trade-offs. But what you've got to do is understand the trade-offs. So you make better informed decisions. You're aware of those trade-offs, and you go, "I'm happy with X, Y, Z trade-offs in lieu of this other option because of their trade-offs." Right. So all we're trying to do is share information here, so people can go away and make better informed decisions about how they go about investing, because it is scary, Benny. You end up taking on quite a degree of risk when you invest, and that's true of pretty much any investment vehicle, but it's also true for cash, right? We spent 3 episodes talking about the risk for you carrying cash is the absolute complete erosion of purchasing power. I'll give you a little example to put a pin in this, right? So say grandma has got 500 grand in cash sitting under her mattress, right? And she dies, and the whole family inherits this 500 grand. Say you're the sole inheritance, right? Grandma's loaded. She's got 500 grand under a mattress. You come into 500 grand. If you do nothing, but you keep that cash and you put it under your mattress, right? And we've spoken about inflation rates and how they're different for other people. And I use the example that for me personally, like tracking a little bit of my inflation rate, it's actually up around 10%.
Yeah.
If you put that 500 grand under your mattress and you are suffering 10% inflation year on year, guess how much that 500 grand's worth after 30 years in today's purchasing power. In today's purchasing power, that it's about 25 grand.
Yeah. Wow.
That's what 10% will do and erode your capital over 30 years, is absolutely destroy it. And in contrast, when you're trying to save it week to week, and we spoke in the last couple of episodes as well, you get to this point, your number one goal over these last couple of episodes was to increase your cash flow. And we're going to speak more and more in future episodes about different ways to do that, different hustles that you can take. I'm really keen to start exploring, bringing people onto the show who have unique ways of the hustle, of making extra money. But ultimately try and increase your cash flow. That is number one, so that you are in a position to be able to invest. Now, we spoke also about the fact that when your money doesn't work, it actually starts to distort your behaviors, because when we know saving doesn't work, we then bring forth consumption, because we would prefer to, if that $10 that we save at the end of the week, or $20 that you save at the end of the week is not going to do anything for you, which arguably we've proven that that's true, you're going to go and get the buzz. You're going to go buy the 6-pack rather than save the $20. So this is where, if we can show you some things that you can do to shift that preference, then you'll start to change how you shop, change how you start navigating, change how you start spending, change how you start change how you consume. And then if the $20 can become $30, become $40, can become $50, it's actually very, very rewarding when you can start putting that to work in active vehicles that will provide for you in the future, right? And I've seen it time and time again, man. It's not me thinking this will happen. It's me knowing this has happened because I've seen it time and time again.
Yeah, this isn't guesswork. This is
not guesswork.
It's happened.
I've lived it myself, and I have many, 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 many people who have drawn off this experience.
All this information, and like we've said before, we are not financial advisors. You're not a financial advisor. We're not here to give people financial advice.
I'm a dumb Sparky, mate.
Take all this information as you will. But if you've put into place just a couple of the things that you've mentioned already, the streaming services, get rid of 3 of them. Keep one. Keep KO Sports and watch the Broncos get pumped every weekend. Or keep bloody Netflix and get rid of the rest of them. Or keep, start going through all your subscriptions. You're already saving money. Just dial all that shit in and you're already saving money. I know that everyone I've spoken to about this are doing that. Like, people are already doing that shit. They're already saving money. People are going to their bosses asking for a pay rise. People are going in and salary sacrificing their super.
Yep.
Like, all these little steps are making you money. So this isn't guesswork. Like, this isn't just this isn't just wishy-washy. Oh yeah, if you do this, this might happen. You're definitely going to save money if you do this shit.
100%. And and we've said it again, and I'll say it another time, the Barefoot Investor has the playbook for you, right? If you don't know what we're talking about, you don't know where to start, get that book, just start going through it. Put everything that he says basically into play, and you'll be better off. If you do nothing else, right? Ignore every other episode that we do. If you just do what was in that book, you'll be better off, 100%. That is financial advice. No, we don't give financial advice, but that is as close to financial advice as I could give you. Is if you did nothing else but try and follow his book to the extent at which he lays it out, you'll be better off. And then we're going to expand on that, right? So he gets to a point, and I've said this in the last episode. He gets to a point where it's good for most people who, I guess, even if I'm to put myself in his shoes, he probably wrote it knowing, Jesus Christ, not many people will even read this book, let alone any other books. Therefore, I need to cap the advice to a certain degree and not go any further, right? So
what year did that book come out? Do you know?
Oh, Benny, put me on the
early
spot.
2000s?
I reckon. Yeah, I reckon like 2015 or something like that, mate. If I was to have a guess, yeah, yep.
Oh, well, no. Well, audiobooks and that were big back then, so.
Yeah. And I think like under that assumption, right, was, if they only read one book and it's this book, then I have to cap the advice to a certain degree that'll see them out. What we're going to do is probably take the latter half of that book and start expanding more on it. And part of that is what we'll explore today. Like, all right, Daz, so I've got my safety net in my bank account for the rainy day, for the car blows up. I've got that. I've changed my habits. I've taken another hustle. Husband's changed jobs. He's got his pay rise. He's taken on some overtime. We've got capital to put to work now. What the hell do we do? Right? Now, we're going to park self-managed. We're going to park superannuation for a while. We're going to come back to that in a future episode. I do think that is a great option. And we'll explore that to more of an extent.
You think it's a great option, like putting more money in your super?
Yeah, it's an option.
That's capped as well, though, isn't it? You can only put a certain amount into that.
It is, and there's tax advantages to doing it. And like I said, I think we'll put a pin in it for now, and we'll come back and we'll do a whole episode on superannuation, because we can really tear a lot of that apart around options, because it does suit some people. What we'll just focus on now is, let's assume that we've got extra disposable income from multiple sources. Might not even be just your single wage, right? But say you're starting to get more than your fire extinguisher, extra, emergency savings in your bank account. Now we've got extra to start playing with. So what we're going to do today is go through, and I'm going to start teaching you, and this is why I'm keen, Benny, start firing questions back at me, because there's
100%.
probably going to be a lot of assumed knowledge that I will just tout through. And if you're asking the question, there's going to be more other people that will they'll be asking the question. So we're going to start with bonds. Okay. Now, bonds, even from the traditional, and I'll call people retail investors, right? That's how we're normally termed, is just retail investors, just ma and pa trying to put some money to work, right?
Yep.
Bonds are an avenue that are probably more used for hedge funds and larger wealth, or on your behalf within superannuation funds, okay? But they are accessible to everyday people. Now, what a bond is basically a corporation and a government's way of borrowing money without going to a bank and getting a mortgage like we would be used to, okay? What they do is they issue a bond. Now, how that would work, if I'm the Australian government and I want to go spend on some infrastructure or bloody another NDIS service provider, right? I'm going to go out and go, can I please borrow $10,000? And I will do that in multiple tranches, right? So I'll issue all of these bonds. And basically what that does is it goes out to the market, right? And that market is huge. That market is primary brokers, it's banks, it's hedge funds, it's investment funds, it's superannuation funds, it's ma and pa, it's anybody with capital to put to work. They will go and say, give me $10,000. And I'll use an example. There's a whole heap of different things that we don't have to get bogged down in terms of duration, which is how long it goes for and all this sort of stuff. But let's just keep it really simple. $10,000, 10-year bond, and I'll pay you 1%, right?
See, this has got me asking questions already.
Great.
So this money, the government's going to these people that have got the capital sitting there already. They're borrowing this money to give to other people to build infrastructure and do all the sort of stuff they want. So they're giving them a 1% return over what?
That's just an example. It's higher these days.
Yeah.
But we have been as low as that. When I started writing our book and our course, those government bonds were as low as 1%.
That is wild.
I actually don't know what. I should probably look it up, and I'll pin it to the post. It's probably up around. I don't know what the Australian ones are. The US stock market's about 4.5%, I think. Yeah, right.
So they're borrowing this money off these companies that have got this money already,
off anyone who wants to give it to them,
and they're giving this money to people to build or do whatever they want to invest in.
Yeah, so that will be what the government uses to go and, stimulate the economy, and pay for services, pay for schooling, pay for all of these things that governments run, right? But essentially what they do is they issue these bonds and they go, you give me $10,000, I will hold that for 10 years and I will pay you back 10 grand in 10 years time. And for your effort, I will pay you a coupon, which is just the interest rate. And, that gets distributed. However, there's a number of different ways they distribute it. It might be monthly, quarterly, yearly, whatever the case may be, right? But it has been as low as 1%. At the moment, like I said, it's probably US Treasury is probably at 4.5%, somewhere around that. I don't track it that often, that closely anymore. I used to, a bit of a nerd. But that's essentially what you're doing is going and lending your money to the government. You're getting 4.5% back, and they will pay you back the capital at the end of that duration, whatever you signed up for. And that example I used was 10 years. Now, that works well if all you need is income, right? Say you got a shit ton of money already, and you don't need to grow that anymore, but you want a nice, steady, safe income. Arguably, they say, and this is arguably, I say this in inverted commas, arguably, they call that the risk-free rate of return, right? They say it's risk-free to lend to a government. And why they say that, Benny, is because they know full well the government can just print more money and pay that back later on through other mechanisms. You're going to get that money back. So they call that the risk-free rate. And why I bring that up and why I'm talking about it right now is because that becomes the hurdle rate for investing. We spoke about hurdle rates for yourself a couple of episodes ago about inflation's your hurdle rate, right? But when we talk about investing, the risk-free rate of return is the hurdle rate, because why would I take on more risk when I could just lend to the government and get 4.5%? That's the risk-free rate.
Another question that I guarantee other people are going to ask, right?
Yep.
So I can just, if I've got capital sitting there, right, to invest, I can just go give this to the government now as a bond, and I'll get this, whatever it is, 2, 3, 4% back over the course of the deal, and then get that money back at the end.
Yep.
That's an investment option.
100%. That is an investment option.
See, I never even knew you could do that.
Yep. That's facilitated through things like stockbrokers. There's other ways you can do it, and we'll talk about ETFs later. ETFs are arguably a better way to go about doing that because you can diversify it somewhat, get exposure to many of them. And then importantly too, Benny, that bond then trades on a secondary market, right? And it will trade in and around the risk for the government, right? So say if I lent, I don't know, what's an obscure country, like Venezuela, right? I lent them 10 grand. They've got bonds too, you know, in their own markets and stuff, right? The likelihood of them paying me back might arguably be lower than the US, right? So the US bond can actually trade at a premium, which then starts to squeeze that interest rate.
Yeah.
Likewise, my Venezuelan bond that I bought for 10 grand might only be worth 8 grand now, right? Because someone's got, and there's no way, I don't think they're going to pay the 10 grand back, but I'm willing to pay 8 for the risk. So that's where your interest rate starts to trade at a premium or a discount to that coupon rate. Now, this is where governments get worried, right? Is when confidence and faith in the government starts to erode, that interest rate then starts to trade on that secondary market and might start to get higher. Because if I don't trust the government, right, then the value of my $10,000 bond starts to trade lower. This starts to get a little bit complicated, probably not where I wanted to go today, but I'll spend a bit of time on it.
Yeah.
That then incentivizes me to put pressure on my central bank to make interest rates. I can issue new ones, right, at a lower rate because I want to control the interest rate. And the only mechanism by which I can do that is via the effectively pseudo printing money. Like when I introduce debt, it's like printing money because debt spends exactly the same as credit, right? But the only other mechanism I can do that through is the actual central bank, which will legitimately print. And I spoke about this last episode. They don't even print it anymore, Benny. That's the absurd thing.
Yeah.
We can understand if they fired up the old money printer, started squeezing that paper through them, they're marking it out. They don't even bother doing that. They just add a zero to central bank's balance sheets and reserve and primary brokers. So that's probably getting a little bit distracting. But essentially, that is one investment vehicle that you can have, right? Is lend to the government.
See, I guarantee there's 90% of the people listening to this episode would not know that's an option.
Yep.
I guarantee that because I had no idea that was an option. I didn't know you could do that.
And then likewise, we start to talk about corporate bonds now, which are the same mechanism, but a large corporation who trades on the stock market, for example, like Apple, they don't go to the US equivalent of Westpac and go, can I please have a loan? They don't. They go to the market and they will issue corporate bonds. Now, a corporate bond should trade higher than a government bond because remember, we call the government bond the risk-free rate of return. The government can print money. Apple can't print money. Therefore, if I'm going to lend that $10,000 to Apple, it's natural that I would want a higher interest rate for my trouble, right? Because now I am starting to go out on the risk curve because Apple might be a very sound company to go and invest in, but it's still not the government. They still can't print money, but I'm going to want some type of premium above that risk-free rate of return. So I might want 7% instead of the 4.5% the government are willing to give me because now I'm taking on a little bit of risk. And then obviously the dodgier your company, the higher interest rate you're going to have to bid up into the market. But they are some investment options that you can go down the route of. I don't find for most everyday people that they are going to be a very good investment decision while you're in accumulation phase of trying to grow assets and trying to get yourself into a position.
How many people do you know that invest in these bonds?
Personally?
People that do it? Yeah.
Look, well, I think everyone probably would if you're on some sort of balanced superannuation, but actively themselves, only very, very wealthy people in my.
Is our superannuation money getting invested into these things without us knowing it?
Depending on your option, mate, I would say it's highly likely that yes, you'll have some part of your superannuation in these vehicles. Yes.
If you had because you got like the high, medium, low risk category. If you were like in the high risk category, you tick that box, you will be investing in these sort of things.
No, I reckon more on the lower end of that scale, Benny, because they are considered, when we start talking about risks and factors, they are considered lower risk than some of the other things that we're going to explore, like equities and stuff.
There you go.
In that balance. So if you were on the lower end of that risk spectrum, high risk would be equities and probably tech stocks and stuff like this, right? And we'll speak a little bit more about that a bit later. But down the lower end of that risk stack is bonds. Now, why that is, I'll spend a little bit of time on that. We will talk more about equities. So we'll circle probably back to this point, but why they are considered lower down that stack. If Apple has stocks, right? It's got shares in its company and it's got bonds.
If it goes tits up, someone's covering it.
If it goes tits up, what happens is, I'll try and simplify it, but they essentially they go into administration, they start paying out debts, right? And they start liquidating assets. Now, bondholders are higher up on that stack. They will get paid out first before any shareholders. So that's why they are considered a bit risk. Safer. Yep. Yeah, a bit lower risk. However, the trade-off you're making then is you're not getting a massive return, right? And we've spoken about your hurdle rate. So you've got two hurdle rates. One hurdle rate is risk-free rate of return. I've got to get better than that in order for me to go out on the risk curve. But my second hurdle rate is I need to beat inflation, my inflation rate. Because if I'm lending to Apple at 6.5% but my inflation's 10.5%, I'm still going backwards.
But our hurdle rate, the first one we've got to worry about is the inflation in our day-to-day lives.
That's the main one for you.
First. Yep.
That's the main one for you. So this is where we're trying to come back to what am I doing with that? What the whole reason why I'm doing this with this money, Benny, that I've managed to squirrel away is so that I can beat my inflation rate and get ahead. 100%. Okay. So bonds, in my humble opinion, won't tick the box for most people in that accumulation phase of trying to build wealth for themselves. When you transition to retirement, they might form part of a wider investment portfolio where you can start to get income, because now when I'm in retirement phase, I'm not so worried about growing the size of the pie. I'm
Just
trying to live off the pie and hold on to as much of it as I can. So that's probably not a bad trade-off to make, having some of your wealth distributed to you as an income through that coupon, and that's what you live off. So you don't have to sell your assets and live off the sale of your assets. You can use those assets to get parked and then earn an income from them. So that's that combo for the retirees.
That makes a lot of sense, though.
It does make a lot of sense, and it's not a bad option. And there are some different ways. Now, also within that corporate, so the corporate bond sphere is what we call junk bonds, right? So they are a bit higher risk, but you'll get higher return, right? And they are probably starting to delve into the less than favorable companies, right? With questionable balance sheets and questionable longevity. They're not the Apples of the world. Apple aren't a junk bond provider. You'll find some obscure listed company that'll issue paper and issue bonds at a riskier rate. But that's essentially bonds, right? That is one investment vehicle. So if you compare it to cash in the bank, right? We know cash is trash, right? Ray Dalio says cash is trash.
That's it. That's the bloke.
That's the bloke.
Thanks, Sammy,
Ray,
for that question.
Ray, yeah. Sammy, one of the lads reached out. Ray Dalio,
Sammy,
probably
Davies, absolute legend.
One of the most famous investors of all time. If you spend any time reading these books, you will inevitably come past Ray Dalio, and he says cash is trash, right? So that's a trope that he's credited with. So bonds are arguably better than cash in the bank because you're on the risk-free rate if you're lending to the government. And there are some risks with having cash in the bank, and I might even come back to that if we got time in this episode. Now, next thing, if we're not going to go bonds, any other questions about bonds first, Benny?
Yeah, well, like the bonds, when you watch Wolf of Wall Street, right?
Yep.
What's he selling? He's not
Penny
selling
stocks.
bonds. He's not selling bonds, is he?
It's a great segue into equities. Okay, so now we're on equities. Equities, shares, stocks, same thing.
Yeah.
Right.
So bonds are completely different, yeah?
Bonds are different. Yep. Bonds
are you lending the money with a guaranteed return that the money you've give them at the start is gonna come back, and you're going to get a certain percent of you're going to get a certain interest rate on the money you've invested over the course of that agreement, right?
Yep. And it's distributed.
And your agreement's going to change. Your agreement could be anything, but your interest rate depends on the risk versus reward, like how big the company is or who you're investing with.
Yep. And the mark, and what you find, Benny, is these things actually are market weighted, right? So it's about the balance of supply demand. So if I'm Apple and I want to issue stock, I'll do it at 5% if there's enough people willing to buy it, right? So it's a market matched dynamic. So that's how it's supposed to work, is more of a market matched dynamic where I'll go, hey, who's going to buy my bond? And it goes out to a market, then people bid, right? And then the interest rate sort of gets settled in around the margin around, well, what's the appetite to lend me money as Apple, right? So it's not like Apple necessarily comes out and said, they'll have a target. They'll go out and say, well, let's issue X amount of debt. We'll issue $10,000 bonds. And we want to target 6%. That's the max we'll want to pay. They've got the option not to issue, right? But they'll go to the market, and then the market will bid and go, hey, yeah, I'll give you 5%. I'll give you 6%.
Who are these options bonds open to? Can these big companies? Can these big companies just go, right? I'm going to get 4% off Apple. I'm going to go put $10 million into this.
Yeah, so it's a lot of the primary brokers and big hedge funds and big money. Big money's normally at the table there doing those deals and making those.
So big companies can do this sort of stuff and just keep buying bonds from these companies and just go on board.
Oh, yeah.
Making this little
financialization, right? there's whole financialization markets now because of the fact our money, and it's arguably grown bigger and bigger and bigger and bigger and bigger because everyone knows our money doesn't work. So now you are forced into using, and same thing, Benny. Nobody's got time, effort, or energy to go and understand this shit, right? So if you've got money, you will absolutely go and use some of these, institutions, funds, exchange traded funds, which we'll talk about a bit later today, to go and facilitate that because it takes a lot of the heavy lifting off you, right? To go and exercise it and go, yeah. But we'll come back and we'll focus on equities now, right? So equities, and I might have used this analogy in a previous episode. So apologies if it is, but it is an apt one. It does resonate, right? The problem with equities is essentially a share, or I'll call them shares, I'll call them stocks, I'll call them equities. They're all interchangeable, right? But essentially, you buy a share in a company. You are physically buying a share in the ownership of that company, right? Now, what most people disconnect when we're talking about the share market in general is something that underpins everything. And this has been my whole journey through this space is valuation. What is it worth, right? Now, the analogy I use is everyone can understand this, right? You go down the road, your favorite coffee shop every day, and you go, that is a great business. There's lines up out the door. I have to wait 10 minutes. That's an awesome business. Now, if you're going to go and invest or just to buy that outright, you're going to ask a certain amount of questions, aren't you? You're going to say, how many cups of coffee do you sell a day? What is the margin? What is the profit margin that you make on each cup? How much are your beans? How much are your cups? How many are you selling? What's your trading range? How many staff you got? What are your overheads? It's natural instinct for people to understand, what am I buying? It's a natural part of that value conversation, which we keep talking about, is we inherently understand value. Now, why is it, Benny, that someone says to me, I just bought BHP, and I say to them, why? And this is an exact example. I will not use names, right? But there was a bloke at work. He's an older bloke. He's fluttering around the stock market. He loves it, right? And he said, I just bought BHP today. And I said, oh, why is that? And he's going, because it's 6% down from last week. And I said, great. What does that mean? And I can't remember what it was, right? But it was like something in the order of, it was $52 last week per share and is now 45. And I go, great. What does that actually mean? And he just looked at me dumbfounded. I said, what's BHP worth per share? Looked at me dumbfounded. How much debt do they have? Looked at me dumbfounded. How much shit do they sell? What assets do they own? And the truth is, Benny, it's a loaded question, and I actually don't expect anybody to be able to answer those questions because it's so complex. But essentially, that is the exact work everyone should be doing. At least start to ask the question, what is that company worth? Now, where it gets really, really hard is a big company like BHP. It's actually near impossible to really understand its true value.
You could never understand how big it or what they're making or what they're doing. Like, they're that big.
100%.
BHP, Rio Tinto, all them big companies.
They're ridiculously
But it's because so
huge.
many people are investing in them, they think it's safe. They think it's the way. They think it's the way to go because it's so big. It's huge. The other big one, the other one at the minute. I know we don't want to go down this path yet.
Yeah.
The one that is going berserk at the minute, and I know people that are investing a lot of money into it, and I'm trying to tell them not to, but I don't give this advice, is XRP.
Oh,
I have no idea about it. We're not going to go there yet.
We're going to park that. We're going to park that. We're going to come back
later.
We'll come back to that.
Back to the equities.
To be honest, Benny, that whole question in and around crypto probably deserves its own episode
segment.
Yeah, altogether. But yeah, we'll put a pin in that, and I'll guarantee you, BHP is infinitely easier to value than XRP. And
but the reason why I mentioned that is because everyone's talking about it. That's why people think it's valuable, and that's why people think it's safe, and that's why people are investing in it, because everyone is talking about it. Same as BHP, Rio Tinto, people invest in these companies because people are talking about it and they think it's safe. But you never know. How do you know it's safe? How do you know it's worth investing in?
Yeah. Now, there are ways you can value stocks, okay? And this is where I cut my teeth. Okay, this is where I started to really understand all of this space, was this journey of trying to value stocks, because it's not beyond your ability. However, it is complicated. Okay, now, what's involved in really truly trying to understand and value a stock is a few metrics, and you can shortcut some of this, right? And I'm not suggesting people need to go down this route of understanding, but I'll just try and paint a little bit of a picture around what would be required in order for you to be able to do it. Now, you need to be able to read a balance sheet, okay? You need to be able to read an income statement and a cash flow statement, all right? Now, this is where BHP is a really complicated beast, right? They've got mining, they've got leases, they've got equipment, they've got assets, they've got metallurgy reports.
Huge.
They're hard, right? But there are other companies that are arguably easier to value if you can strip back to their basic bones of their core business, right? Now, Warren Buffett, everyone's probably heard that name before, and if you don't know who that is, he is arguably the most successful value investor on the history of the planet. Okay. Mm-hmm. He's still kicking. He's still, I think he's just about handing over the reins of this behemoth called Berkshire Hathaway. But his whole thesis, right, he's in his 90s. There's a book here called, it's a tome, dry as, called The Intelligent Investor. It was written in 1940 by a guy named Benjamin Graham. Okay. This book basically goes through how to value a stock. It is dry as. I do not recommend reading that. It was tough to get through.
Yeah, just give us the nuts and bolts of it.
But what it does is there's a few basic principles that still resonate through to today. It's like, go and find good companies that are easy to understand with good moats. A really good moat is Coca-Cola, right? Coca-Cola have nailed that brand, that flavor, that they have a moat. Pepsi tried to attack it. Dr. Pepper tried to attack it. It's arguably one of the best. Anywhere. Yeah. It's not going anywhere. No one's attacking Coke, right? That's what they call a moat. So you find good companies with good balance sheets, good, don't take on too much debt. A good company is just like anyone else, right? You shouldn't have too much debt if you're going to go and buy this company. Now, that is accessible to go down the route of finding all this stuff out. But then you've still got to bring it back to how you value that stock, okay? But, we won't spend too much time on that, but there's a few different models you can do. I was a big proponent of something called a discount cash flow, right? Where you would take their assets, you would take their growth over the last 10 years, you take any dividends that they pay out, which I'll talk about in a sec, and you can model this out to say, well, if BHP is trading at $45 and I want to beat my hurdle rate, right? That thing comes back again. If I want 10% return to go out on the risk curve and buy BHP, what would I need to buy it for today in order to be able to get that consistent return over the next 10 years? They call that a discount cash flow. Now, that is probably beyond anyone's expectation of being able to do, but I'm telling you that is the kind of thing that's essential to be able to understand if you're going to play in that space and have a good understanding about what I am going to invest in, right? Now, because of the fact that is so complicated, in the 90s, knowing all of this, that actually understanding what you're buying and valuing a stock is super, super complicated. So in the 90s, they started developing these things called ETFs, exchange traded funds. Now, what they do is allow you to take a diversified approach to a lot of these investment types of things. And there's ETFs that cover a lot of different types of investing. So bonds, there are ETFs for bonds. We spoke about bonds. There are ETFs that you can buy, which will buy a whole package of different bonds. And there's a whole heap, there's thousands of these ETFs for you to go out and explore, right? But essentially what they do is they, if I come back to the equity example, knowing that equities are really hard to value, what they say is like that's mostly out of most people's time, effort, and capability to go and do it. So how can we take a more diversified approach to getting exposure to these things where potentially we do it passively or actively, right? And what I mean by that is if you're doing it passively, have you heard of the term index funds before, Benny?
Yep.
And when
No
you watch
idea
the
what it means,
news,
but I know. Yep.
when you watch the news, they use the indices, right? They say, let's go and report on the indices. And they go, the S&P 500 is up 4.2 points.
Yeah.
S&P 500 is an index. Now, this index is S&P 500, as an example, is the top 500 companies in the United States. There's a few caveats that they need and a few things that they need to criteria they need to meet in order to get included in that index. But for all intents and purposes, they are the top 500 stocks by market weight in the US market. So in that S&P 500, you will see Tesla, you will see Apple, you will see Nvidia, you will see all of these big names that we hear time and time again in that S&P 500. So knowing full well that you don't have the capacity to go and value that stock, Benny, what they'll do is they'll say, well, why don't you just buy all 500 of them? And I think I've mentioned before, every book that I've read over these last couple of years, they've been published for even Benjamin Graham's book here, right, that says here's how you would value a stock. But by the way, you're really going to struggle to beat the market. So just buy the market. So I'll repeat that in case we need to blip that out because it's an important point.
Blip that out, definitely.
Yeah, if you can't beat the market, you need to buy the market, okay? And a lot of hedge funds, even these really big, successful money managers who people go and entrust, trillions of dollars to do, actually struggle to beat the market, right?
But now, you can just invest in these top 500, can't you?
Yeah, so these exchange traded funds basically say to me, Benny, you give me $1, I will go and automatically buy every single one, at a market weighted average, all 500 of those companies, right? And that's what a lot of our superannuation companies use, and a lot of these hedge funds even use. They will just go out and use these vehicles because nobody, and this is the whole problem, in my humble opinion, with the equity market. Now, what this has done, this has created a system by which nobody is doing what we call price discovery. So when I want to go and buy that coffee shop down the road, I've done all my due diligence. I've done price discovery in and around, well, you sell $10,000 worth of coffee a month. I think you're worth, I don't know, some multiple of that, right? I'm willing to pay you $400,000 for your coffee shop. I've done the price discovery.
And there is a calculation you can do to get to that number. When you're buying, say you're buying a coffee shop, there is a calculation you can do with how much money they're making over a certain period of time and how much they've been running and how much the business is going to cost. But people don't do that with stocks. Like when people are investing in stocks, they go, oh, this is making money. Bang, take my money.
And it's been made worse by this reinforcing mechanism of the ETFs. Now, I humbly believe, right, that if you're going to go and invest in stocks, you probably should use these ETFs, okay? Because of the fact that it's a self-reinforcing mechanism. It's kind of making itself come true, all right? The danger with it is I don't invest in ETFs because I know full well that using that S&P 500 ETF, I know I'm buying Apple stock at multiples upon multiples upon multiples of what is considered fair value. Now, don't get me wrong. Apple is very hard to value itself because it's such a behemoth, right? To actually find what it's worth per stock, per share. However, I do know that now this is well documented. There's a guy named, his name's eluding me. He goes by Professor Plum on Twitter. Someone green, can't remember his name, but he's done
the old board game.
Yeah, off the Cluedo board game.
Cluedo,
yeah. He's done a study that has basically proven now that over 45% of capital flowing into these equity markets is what we call passive investing, meaning that 45% of money coming in is doing zero price discovery using these vehicles. Therefore, we've shifted from a regime of what made Warren Buffett wealthy, okay, value investing. We've shifted away from that to what we now call momentum investing. And AI tech stocks is a great example of that, right? If you bought Nvidia 3 years ago, you're laughing, right? Because it got on a trend. Now it's trading at multiples upon multiples upon multiples of what the underlying valuation is based on anticipation of AI taking off and them continually going to, produce. And some of that will get filled. Some of that is legitimate. Yeah, it probably needed a bump up in stock price because they're going to be doing such great things. But because everyone now uses passive income and they're trying to ride this momentum train, we're so far removed from that true metric of valuation. No one's doing valuation investing anymore. Like no one in superannuations and everything is actually taking the time to look under the hood and go, what is that equity worth?
So everyone's just throwing their money at it because
it works.
It's like the fad. Like it's like this is going to be the next thing. Throw your money at it, bang. So you're saying 45% of all the money that's going into these stocks are just people just throwing money straight at it without even looking at it.
Without even looking at it, no one's doing any valuation except Benny. There's always, for every sale that comes into the market, there's a seller. Who do you think the sellers are?
Stockbrokers.
The people who have held that stock from day one, the VCs, the guys who got in early, and the people who know if you're willing to sell Apple stock right now, right? It's a great company. Why would you sell Apple stock?
There's not an infinite number of this stock, is there?
Well, that's another question. I'll come back to that question because that's a good point. For all intents and purposes, no, there's not. However,
so someone could hold all that stock in one person at the start. Look, this is all my stock, and I'm gonna offsell it to people.
There's some caveats in there, but essentially the point I was trying to make before we move off that one, right, is that just know for every, and I say that, and I hate using this term, but that's what they call us, dumb money. They call us dumb money, right? 100. People who don't know what they're doing and they just have to put their money to work. Like superannuation is a forced mechanism by which we have to save, right?
It is a forced mechanism, yes.
So that's dumb money is coming in, but the smart money are the ones selling, okay? They are on the other side of that. Someone is making that calculated decision that Apple is oversold. At this price, I'm willing to sell it, right? Because the dumb money's coming in going, I don't care what price we pay. There's someone on the other side going, well, I'll sell it to you because it's a market. It's always matched. So they're the only ones doing, the smart money, the only ones doing these economic calculations to say, well, what is it actually worth? Knowing full well there's 45% of the capital coming in going, I don't care, give it to me, pump it in my veins.
But is this price changing depending on who's selling it? So
yeah, it does. And there are some market movements on the fringes of that, right? So there's a lot of what we call institutional money, these big corporations that can move stock. Can absolutely happen. And there are some fringe cases as well, like your superannuation fund might not use all ETFs. They might do some fringe direct investing as well based on markets. Like you are paying them a fee after all, but a lot of it is just exercised through market trends. And now these ETFs, they're huge, right? There's index funds, there's mining stocks, there's energy stocks, there's uranium ETFs, there's a whole heap. The world is your oyster. If you think I want to invest in copper, there's an ETF that will buy.
One now, isn't it?
AI is a huge one. But AI then starts to seep into all of these other. Now, here's an interesting thing for you too, Benny. One of the big goals if you're a publicly traded company, one of your massive goals is to get included in the indexes, okay? Because you've got all of these founding members that you went to the market. You say, I've got a great product. Give me some money so I can build a company out of it, right? Your number one goal is to get it into these indexes, knowing full well the rebalancing that happens. So as soon as my inclusion, Tesla was a great one. Tesla back in, I'm going to stuff the date up, but it was around 2020, 2021, finally ticked enough boxes to get included in the S&P 500. Now, on the run-up to that, there was a lot of anticipation going, oh, shit, I'm going to buy a lot of it because I know it's going to get included in this index. So it had a bit of a premium already. Yeah. But as soon as it comes into that index, one goes in, one goes out. So the bottom rung, you're probably a company you never heard of, got taken out of the S&P 500. Tesla gets put in. Now, automatically, every person who holds that ETF has to rebalance back out, and
did
automatic.
Tesla didn't automatically come in at number 500 though, did it?
No, so they've got to meet a few things, and then they will come in wherever their market weighted average for that particular index, and they're all slightly different, right? For that particular index, if they were the top 30, out of that S&P 500, like in terms of market cap, market weighting, the valuation of the company, then automatically you'd be buying, whatever it would be. Let's call it.
But then the bottom of the rung went out. Whoever's number 500 is making the least. Whoever
didn't,
the least.
Yeah. Or
gone.
whoever didn't make the criteria. Yeah. They're out. Right. So everyone's forced sellers of that company. So as soon as they go out, they go down. But then as soon as Tesla comes in, they anticipate stock price pumping because now everyone's a forced buyer, right? And who is the sellers? Those early VCs, the early guys who said, I'll go out and take a risk, give you some money, give me some stock, give me outweighted voting shares.
This is wild. This is wild now, explaining it like this, and you can see why these guys spend their whole life just watching all this shit and watching it go around and around. So investing in this sort of shit all the time. And keeping an eye on these companies and pushing all this shit and seeing who's coming in and out of it, it's wild. When you think of it like that, I've never even thought of it like that, but now when you think of it like that, you watch these companies come up and they start getting included. Then these guys with the company that's getting kicked out, they're selling all their shit, right? So they probably got miles of stocks in this company that's down the bottom, but no, they might be on risk of getting kicked out, so we're going to sell that, get rid of that. And
there's a reason they call us the dumb money, mate, because we don't, you're not dialed in, you're not doing this every day. That's why they call us the dumb money, right? So this is just to paint the picture on equities. So equities are, if I just come back, equities are an option, right? And they're a pretty good option in terms of returns. The trade-offs that you're making, though, is like, how are you going to go down the route of investing in these equities? Are you going to use these index funds, these exchange-traded funds? There are some fringe cases where that might make a bit of sense, but just understand what you're doing, right? The trade-off that you're making is that you're going to go down and you go do this passively. Now, the big exception that I have to this, Benny, is this is all well and good when things are rosy, right? But if and when shit hits the fan, you will be the bag holder. You are the guy left holding the bag when they decide, hey, I'm not going to print money anymore, right? This is why I keep coming back to this notion of you're so beholden to the decisions of a few people in this world, and you are, right? The Federal Reserve of Australia are 12 board members, I think, from last count. That might be mistaken, but there's a group of people making these decisions on behalf of the whole United States and arguably downstream to whether they print money and control interest rates or they don't, right?
Yeah.
So if they don't, things get ugly really, really quickly, and then what they call mean reversion. So there's an argument, right, that everything reverts back to the mean. Everything comes back to true value. Like if that's my valuation, we can trade up here and we come back down. We might even go under it over a long arc of time. But since this fiat currency regime of 1971, assets just continue to go up to the right. So this puts the counter argument to what I've just spent the whole episode so far talking about is, well, what are my fucking options, Daz, right? So if you are going to play in the equity space, arguably your safest avenue to go about that is to actually use the same thing I've just spoken bullshit about with the ETFs, because it's a self-reinforcing argument. It's very, very hard to pick individual stocks and buy the market when valuations are, you don't know what the underlying value is, right? So therefore, if you're going to play in that space, you probably should use an ETF, but just understand the trade-off you're making in and around, I am paying top dollar for this stock. Now, how I use ETFs, and I do have some ETFs, is I will express larger investment theses through ETFs, right? So for me, I don't own any index funds. I don't. Not one. I don't own Apple stock. I don't because I know under the hood they're grossly overvalued. But what I do use ETFs for is to express that I think energy stocks will go up over time. I think uranium has a place to play in the future energy market. So I own physical uranium through ETFs. I can't actually own physical uranium in my safe at home, right? So I have to use a vehicle if I'm going to express that trade through that mechanism. So ETFs do play a role, and it is actually very hard. If I come back to using those index funds, it is actually incredibly hard to beat the market. Now, the market does fluctuate, and the last couple of years have thrown a bit of a spanner in the works, but arguably over the last sort of long arc of time, it's about 8% return average, okay, across a lot of these bigger, broader indexes. So that, again, for me then, if I'm going to buy, and that's true, like the last couple of years have been a bit higher, right, for various reasons. But if that's true, that 8% still not shifting my hurdle rate. My hurdle rate, like I said, is probably more around that 8 to 10% for my inflation. So even after all this bullshit, bullshit, I'm still not there.
Yeah.
I'm still not there.
And it's very confusing. Like, it is very hard unless someone's studying this shit and spending a lot of hours of their day looking into these stocks and equities and all this sort of shit. It's very hard to invest in it. Like, it is very hard. Like, the day-to-day person like myself, I have not got the time to sit there and look at these stocks and work out which one I'm going to invest in. There is no chance that's happening ever in my fucking lifetime.
And now I know other solutions. I don't spend any of my time doing it either. So I pretty much, if you look at it, like wasted like 4 years of my life reading all these books, right?
Not wasted.
Not wasted.
Because now you are giving these valuable life lessons to people.
100%.
So they don't have to waste their time.
And you know, like, if people do a little bit of work in that space to understand equities, you will invariably land on exchange traded funds. Like, you know, I'll listen to a few the engineers at work. They've done enough work to know broadly some investing options, right? Probably more than most people are afforded, right? But I hear the conversations going down, and they haven't gone that extra step to go, well, what is it I'm actually buying, right? And that's the question you need to ask yourself is, if I'm going to use an exchange traded fund to go and express this investing view, what is actually getting bought? And I won't even go into paper claims yet. I might come back to paper claims when we talk about gold. So,
but see, I see it a lot. Let's divert this to day-to-day life where I am up in the Pilbara, right? People making a lot of money. People sitting up there, like, you're up there for 2 weeks. You got a lot of time on your hands. People are investing their money, right? Especially you can see a lot of guys up there there's still a lot of single. We talk about all the married and guys that aren't seeing their families, but there's still a lot of single blokes up there, a lot of single people up there that have been doing this shit for a long time, got a bit of money in the bank. They're investing in everything, right? They're in crypto, they're in stocks, they're in anything they can invest in, they put money into. They're talking about their coin wallet is full, like every different sort of coin you got, they've got 1,000 of them, 1,000 of this. They're watching it every day, right? Watching their stocks go up. But how, like, it is not, I don't see it, like, there's no backing behind what they're doing. Like you said before, how do you know this is going to make money? How do you know Rio Tinto is going to make money? How do you know BHP is going to make money? Like, it's all just going to fluctuate like this.
And that's the number one question everyone needs to come back to, and why I've spent the last 3 episodes talking about monetary premium. Is the why is in and around this monetary premium. Like, when your money doesn't work, that's why you have to turn to something else, right? And now why we are so disconnected from underlying fundamental value for things is because our money doesn't work, right? So that's probably a great segue then to talk about, because where we express monetary premium probably the most in this country, we've mentioned it quite a few times, is real estate, right? And why that is, in my humble opinion, I just spent, half an hour, Benny, ranting on about how complex equities are. And I probably didn't even scratch the surface, to be honest. I'll probably rant for another half an hour, but I think everyone's probably bored shitless of equities.
No, it's good.
So I'll turn my attention to real estate, right? Now, real estate...
Now, this is the big one. This is the big one because this is the common denominator for everyone. Everyone thinks this is the go-to. This is what you should be invested in.
And the reason I think it is, Benny, is because everyone fundamentally gets the thesis, because everyone needs somewhere to live.
And everyone understands it. Like, it's easy to understand.
Everyone understands it. Now, Robert Kiyosaki, wrote this book, Rich Dad, Poor Dad. It's arguably the most famous real estate investing book of all time. He wrote it on reflection of his growing up. His dad was a lecturer, not very successful in terms of money. And then he had a best mate growing up in Hawaii whose dad was filthy rich. And it was more about the discovery and this guy teaching him as he's coming up in how he got rich, right? So he wrote this book. Now, that same guy was interviewed in about 2020 with somebody in finance circles on a podcast in Australia. And he was asked, what do you think about Australia's real estate market and our negative gearing policies, which we can talk about in a sec, and this notion of investing in something on the promise that it goes up in value over time. And he laughed, right? Now, that's not to throw stones at anybody who invests in real estate. And again, I know a lot of people who have done very, very, very well in real estate, but it's not without significant risk. Now, the number one goal from investing is to increase your cash flow. Equities can increase your cash flow. Bonds can increase your cash flow. Real estate can increase your cash flow, but it is very, very, very hard to find that in Australia now because we are trading now at such a premium, monetary premium to fundamental value, right? Robert Kiyosaki said, buy real estate, service it at X, rent it out at X plus 50, right? Yeah. So I buy a house for $500,000. No, I can't use that example anymore. I used to be able to use that example, but I buy a house for $1 million and it costs me, I don't even know what servicing $1 million mortgage is anymore, right? But I'm going to call it, say it's $5,000 a month. I don't know. Shoot me down. Yeah. $5,000 a month to, I'll make that math easy on me because I can't do public math. $4,000 a month, $1,000 a week. I rent this out for, right? Yeah. That's my mortgage. Sorry. $1,000 is what it costs me to service it. I'll ignore real estate fees, maintenance, insurances, all of that. Right. I'm just going to say it's $1,000 to cover the mortgage and I rent it out at $900. I'm going backwards $100 a week. Okay. Yep. Now, why our government in Australia made that attractive is because you could offset that against your income. Okay, you can't really do that.
Which we've spoken about on another episode, yes.
We did. So circle back to that. I won't spend too much time talking about it, but it was actually a pretty ridiculous policy, to be perfectly honest. However, let's not get into politics and semantics in and around whether that was a good decision or bad decision. But no way you sugarcoat it. You're going backwards $100 a week in the hopes that is worth more when you go back to sell it, or you can start drawing down on the equity that you create in it, right? Now, the risk that you take on with that then is there's not too many people in this country who can get into real estate without getting into an over-levered position. Now, when I say over-levered, it means taking on leverage, taking on risk, taking on debt.
Yep.
One of the main reasons why real estate is so successful in terms of returns for people and why it has managed to generate such significant wealth is purely based on the fact that it is levered, that you are taking risk and you are taking on debt. Now, what most people, I think, discount when it comes to is exactly how much risk you take when you are taking on that much leverage. Now, if you've got 2 mining incomes and you've got an investment property, you're probably sweet, right? Because you've got a lot of income coming in. And if someone doesn't pay their rent and insurances don't cover it, then you're probably going to be okay to carry that forward. If you are a person who doesn't have significant cash in the bank to cover that, or you are struggling to make ends meet and you don't have significant excess cash flow, that's really where I take exception to real estate being a really great investment, because you are taking on an inherent amount of risk in terms of what happens if when it's going okay, it's going okay. Right?
Shit, it's a fan though. Yeah, exactly.
It's not. Now, I've been in this investing space for quite a while. The only time I've had an investment property is when I've left the property I'm in now to go travel around Australia and rented it out. That was an investment property for that duration. I do not look at real estate, for me personally, as a
an
good way of
investment.
exercising my options, because I don't like now. People laugh at me because I've probably brought it up a few times already, and it's no secret. I like Bitcoin, okay, and we'll talk about Bitcoin at length soon. People go, "Oh, you're very." I'm actually incredibly risk averse. I am not a risky person, yet I own Bitcoin, and I'm going to talk about the differences why I don't think Bitcoin's that risky, and we'll like I said, I don't want to spend too much time on that, but I'm very, very, very risk averse, and how an expression of that is my inability to get myself into excessive debt just to service a property. Now, I have humbly been wrong since 2020, thinking there was a significant property correction to come. I still think there's a significant...
Elaborate on that. What did you think was going to happen?
When COVID hit, and we locked down, I think I've showed you the graph, the M2 money supply graph.
But what do you mean you were wrong though? What did you think was going to happen?
I thought with people losing jobs, getting locked down, economic turmoil, people would really start to struggle to service the debt, like stop paying rent for one, and then governments would intervene. And this is another trend which I don't like about.
But that's what happened, didn't it? They printed money and just gave everyone money to pay all their shit, and then
that's what saved it. I didn't at the time anticipate that graph would go parabolic like we showed on the last episode. Yep. That's what saved the property market, because we controlled interest rates and we injected stimulus into the economy. We put money into the hands of people by printing money out of thin air, and which is why we're now experiencing so much inflation. Okay, because they printed money out of thin air, and it ends up showing up when you introduce excess units competing for the same amounts of goods and services. It leads to price inflation. It has done it every single time. There is time and time again, and case study after case study through history of why that's a bad idea, and they did it. I do give them a pass. I don't know if that they had that many options, right? But regardless of blame, that's the reality of what we're now living through, right? So where real estate is risky as well, in my humble opinion, is that governments will intervene. You can go and look at Canada's real estate market. Government puts controls in how much you can raise rents. There are state governments in this country that have done that as well. I believe Victoria have controls in and around how much you as the landowner can put your rent up. And to solve the housing crisis, I expect more of that to come, okay? Particularly from left-leaning governments, all right? Now, that's not to get political. Don't get all ranty at me that you love Albo. That's all good. Happy for you. But left-leaning governments tend towards that trend of socialist policies as it relates to housing. And, to be honest, I think they do it in good faith, right? But with a disconnect of economic reality, right? When you can distort natural markets to the degree in which they do and have trended to and have shown propensity to do more, that is not good for natural markets, right? And as a real estate investor, just keep that in the back of your mind, right? With risk, is that you are taking on an inherent amount of risk when you are dealing with real estate, as well as government policy that can intervene into your ability to service that debt.
Exactly. Government policy at the minute, without getting political about this, we'll do another episode on Australian politics and US politics, but we won't do it in here. But I've leaned away from real estate, right? Only just from not just your advice or talking to you over the last few months, but other people's advice that are very smart with this sort of stuff. I'm not going to invest in real estate. I've got my apartment here that I live in, and I'm servicing the mortgage. That's it. I'm running my business. I'll probably buy a commercial property to run my business out of in the next 6 to 12 months, and that'll be it. Yep. You know what I mean? I'm not going to be investing in more investment properties. I don't think I need to service an investment property. I think it's going to cost me more money. I'm going to have to outlay more money to keep servicing this property. Even if it's getting rented out, it's still going to cost you all this money, rates and all the upkeep and all this sort of stuff. It just keeps adding up. And like you said before, a bond or a stock or an equity is turning you over money. an investment property is costing you money. You're servicing this thing. You're paying money into this thing all the time.
Yep.
They
On the
could
hope
ring
that
up-
the property bubble keeps going.
And they could ring up any time and go, oh, the water main just burst out the front. It's going to cost you $5,000 to fix that. Can you go pay for that
Yep.
or whatever? You know what I mean? Anything. Like,
Yep. So you're basically just investing on the hope that keeps going up in price, right? And that has remained true the last 1970 to today, right? The property prices have kept going and going and going. But at some point, talk about this thing again, Benny, mean reversion. Are you going to get left holding the bag? If we do have that property correction and that $1.2 million unit that's not worth a pinch of shit reverts back to $400,000, how long is it going to take you to get that money back, right?
Exactly.
And there are other things like I won't even probably get into, but there are risks in terms and conditions of your loans that most people wouldn't even start looking at in terms of they can margin call you on a house. Like it's loaded and it's probably down the list of probabilities. I think governments would intervene beforehand. But if you have a $1.2 million loan on something that's only worth $400,000 now, they can come to you and say, you need to give me more capital.
yeah, because that's
Therefore,
what's happening.
you'll be a
that's
forced
happening.
seller of your own home
Exactly.
just to service that investment property.
But there's a lot of people over leveraging their equity that they've got in properties just for their sake, just for that reason, because the property they bought, they're saying it's worth a lot more than it might be in 10 years' time. Like, how do you know it's going to be worth that in 10 years?
The other thing I would recommend people do if you're going to go down that route is actually talk to a good accountant, pay the money to do it, and set up your structures. I won't get bogged down into trusts and so forth now, but you need to protect your principal place of residence in that scenario. And there are some structures. Go and talk to a proper accountant in order to be able to set that up properly to protect you in case all of that shit unwinds, right? Because there are, you could go to most of the popular property development and property portfolio seminars over the last couple of decades, right? And the idea is you buy one property, you wait till there's some equity, you use that equity to buy the next one, and then you buy the next one, and you nest them in a way that you come back to the first one to borrow against the line of credit and the equity that you've created to service the debt of all the others.
See, this is still getting pushed. Like, this is still...
It does.
It's still pushing people towards this investment portfolio to get your portfolio up of houses to make money and to set yourself up for retirement. And I'm not saying it doesn't work. Like, I'm sure there's a lot of people made a lot of money off this, right? And this is still there every day of the week. You hear of it. You've got $300,000 equity in your house because you bought this house before COVID, right? And then after COVID, all of a sudden, your house is worth $1 million.
Millions.
Right? So now you've got $400,000 equity. Go and buy something else. Invest all that. Boom. Now you've got another bit of equity you can use. Start renting that out. Then boom, yep, that's coming in. Now you go use that to buy another one.
This is actually, I don't want to segue away too much from this convo, Benny, but that's actually another indicator on why inflation's so bad as well, is like people's perception and sentiment in that they feel wealthy because they've got so much equity tied up in property. The propensity to spend is higher because you feel wealthier. So you're like, oh, I'm worth millions. I'll go buy that new car. I'll go, and that's why prices are so high, is because now we've got this, everyone feels loaded, that they've got down up to their eyeballs, right?
Definitely.
But the danger, I always say to myself, Benny, if I put a pin in this, is literally the pin, is what happens when that bubble pops? What is it actually worth? How much debt do you have? And are you going to be able to service that in the worst case scenario?
Worst case scenario, when it all comes down to the end of it, how much debt are you in? This is a big one. How much debt are you in? And if you had to sell everything right now, how much money is it going to cost you to come out of it? What are you going to have left over?
And what's your tax obligation?
Exactly.
And rolling all of that out as well, because they will come for you.
Yeah, they will. And can we go back to COVID and talk about how Fawzi pled the fifth 111 times in his court case?
Anthony
man.
Fauci. If you want a mind-blowing book to read, Benny, it's totally
That
off
was
topic.
wild. That was absolutely wild. I was watching that the other day. 111 times he pled the fifth in that interview with Congress. That's crazy.
Yeah. There's a wild book by RFK Jr., right? The
legend.
Yeah. called The Real Anthony Fauci. It's about 900 pages of the fuckery that guy caused.
Oh, man.
Go and read. Even if only 5% of it's true, the world is very different than what you thought it was. But anyway, let's put a pin in that conversation.
Yeah, we'll save that for a political one.
People off straight away.
All right, so back to the takeaways from this episode, yeah? So we're in the meat, right? We're into it. So we're
going to need a part 2, Benny, because we haven't finished.
We're going to need a part 3, 100%. So we've gone, but we're in the meat now. So we've gone bonds, we've gone equities, we've gone the housing market, yeah?
Yep.
So obviously all these 3 options have made people money over time. Mm-hmm. All these 3 options can make you money over time if you're smart, but are they your best routes to put we're not talking about the millionaires, right? We're not talking about the people that own millions of dollars, businesses worth millions. We're talking about the people like us that have worked 40 fucking years of their life. They've got a little bit of extra cash in the bank. And when we're talking about a little bit of extra cash, like 50 grand now is like having a 50 grand excess in your bank.
Oh, mate, yeah, that's rare.
Like,
that is rare. That is
100% rare. You got 50 grand, but I'm telling you, if you're smart with your money for the next 10 years, or if you're smart now, if you're a 30-year-old listening to this, by the time you're 40, you'll have 50 grand in your bank at 40 easily done to invest in. If you're putting your 50 grand somewhere, where are you going to put it? Like, I know you haven't got that answer right now, but I know it'll come out, but that's what we're trying to get to. That's the answer we're trying to get to.
Yep. So we'll put a pin in this one today. Look, and again, this wasn't trying to scare people into inaction, right? Because we've said that cash doesn't work. You do need to put your money to work, and there are ways that you can go about diversified access to everything that we've actually spoken about. And if that's where you want to exercise that, that's great. We're going to speak a little bit more about that in future episodes. We're going to put a pin in this. So next episode, what I really want to spend time is we're going to come back to the money conversation. All right. So we'll park this one. These are your traditional investment options. Like, there are others, right? Like I said, 100%. It's hard to deal in absolutes. And there's some fringe cases and some fringe vehicles that you can go that work very similarly. But next episode, what we're going to do is bring this whole thing back to money, right? Because what I've just spent this whole hour and a half talking about is why monetary premium starting to show up in these traditional assets, and where the risk is now starting to come because we're so far disconnected from true valuation metrics, right? What is the underlying thing we're buying actually worth? That is true in real estate. That is true in equities, right? So next episode, we'll come back to the properties of money, and then we'll start looking at, well, okay, if the money's fucked, what are our options for money? Because real estate's not a good money. Equities aren't a good money, but there are some really good options that can replace money as we know it today, and that's what we'll start off the next episode with. Now,
this actual hustle segment isn't going to go into cryptos, is it? But I want to do an episode on cryptos. We need to do. Are we going to get to cryptos eventually?
We're going to speak a little bit about crypto next week.
Or do we need to do a side episode about cryptos?
Well, I'll tell you what. Let's frame it up next week, because it's probably part of the broader conversation for next week. And then
you would be shocked if I told you how many people I know that invest in these cryptos.
I wouldn't be at all. I wouldn't be at all.
The amount of people I talk to up there in the
and it does warrant. I could speak to it now, Benny, but it warrants more.
We need more time. Yeah.
Yeah. I mean, and this is the thing, right? People will, as soon as you trigger them, they'll shut down from the conversation. So it warrants the conversation that is due, that it's owed, because it's not an easy thing for me to say all crypto's bad, right? And the other thing I'll say, because we've brought it up quite a few times, is Bitcoin. I think Bitcoin, from most people's understanding, they think of it as a cryptocurrency. When we talk about Bitcoin, really start to distinguish the difference between the two, because even though it is a pseudo, it is a pseudo cryptocurrency, but like really we're trying to separate it out from the broader crypto ecosystem, because crypto is, and again, yeah, all right, the guy down the street made 10 grand on fucking XRP. I'm so happy for you, mate. Good on you. However, when you look under the hood, for the same reasons we've just spent about with the traditional sense, when you look under the hood to actually understand what's backing most of these cryptos, the vast majority of them are very, very dubious, very, very opaque structures, and scams at best. Outright scams at best.
100%.
XRP will trigger probably the most people out of everything as soon as I say anything about XRP, but I will fully explain my thesis why, because I've done the work. I've gone.
I know you've done the work, and I've been having conversations about it. I just don't understand how they're linking all this XRP to Trump and stuff that he's doing politically, to thinking that it's going to go through the roof just because of what is going on there. Like, I have no idea how that links, and I'll just need you to explain it to me, but we'll do that in a further episode. But yeah. It's too late on a Sunday night for that sort of carry on.
Yeah, we'll put a pin in it. Well, hopefully it's like one of those what do they call them, the clickbait, right? Like, click through to the next episode.
Yeah. We'll come. I guarantee there'll be people listening to that one.
We'll tear apart your XRP thesis. Right.
But
look, and I get it. Like, that's triggering for people.
All the information you're given at the minute, this, like I said at the start, this episode on the Chase Immortal podcast is the most commented on, the most feedback you get is from this episode. Like, everyone is loving this stuff, man. Like, you're a very intelligent man.
Until I shoot down their XRP, then they're gonna fucking come at me.
That'll be fun. I'm sure they'll all benefit from it.
I appreciate the feedback, Benny. It's absolutely, like I said, it's humbling to hear. I'm
so
pleased
good,
it's
man.
resonating with people, and you know, like I said, we'll start that mailbag. If half from tokens is going over your head and you need it stripped down and you want excess explainers, then yeah, absolutely. Yep.
Awesome, man.
Cool.
Appreciate it.
See you,
Do it
brother.
again. See you, bro.